What truly makes a great investment? I mean, is it just finding a company with a fantastic business model, great advantages, a history of making money?
Or is there more to it? Like, does the price you pay actually matter? Does it need room to grow?
Exactly. And today we're diving into that very paradox. You've got this world-class business, Costco.
But then you look at the stock price, and it's got this really premium valuation.
Right. So our mission for this deep dive is to unpack a really thorough investment analysis of Costco Wholesale Corporation. That's a 2OST.
Yeah, we want to shed light on the sort of conflicting views about the stock, and maybe clarify a pretty complex issue in investing generally.
The idea is to help you, the listener, get a clear handle on the advice, the strategy, and the plan that comes out of the expert analysis we've been looking at.
And it's a really detailed analysis. It covers pretty much everything: operations, financials, market position. It's a great foundation.
Okay, so let's get into it. The business itself, what makes Costco tick?
Well, the analysis calls it formidable and self-reinforcing, and it really is quite unique. Get this, over 98% of their revenue, it comes from selling stuff.
Okay, standard retail, right?
Yes, but here's the twist. They sell it at razor-thin margins.
Yeah.
Like typically only marking things up 14, 15%, really low.
Wow. Okay, so if they're barely making money on, the TVs and the groceries,
Yeah.
how are they so profitable? Where's the actual profit coming from?
That's the genius part. It's the membership fees. That's what the analysis calls the primary profit engine.
The annual fee you pay just to get in the door.
Exactly. In fiscal 2023, that brought in $4.58 billion. That was the majority of their operating income.
So most of your profit isn't from selling goods, it's from selling access to the goods.
Precisely. It's this recurring high-margin revenue stream. It gives them this incredibly stable financial base, kind of insulating them from the ups and downs of just selling products.
That is clever, anchoring profitability in the membership. But how do they keep those merchandise prices so low? They have to, right? To keep members happy and renewing.
Right. And that's where their operational genius comes in. This whole scale economies shared flywheel idea.
Okay, scale economies shared. Bring that down.
Basically, they use their huge their scale to get lower costs, but instead of just keeping the extra profit.
They pass the savings back to the members.
Yes, which drives more loyalty, people buy more, which increases Costco's sales volume even further.
Giving them even more purchasing power with suppliers to get even lower costs.
You got it. It's a virtuous cycle, a flywheel.
And how do they achieve those initial low costs? What are the tactics?
Well, a huge one is their limited number of items, their SKUs. A typical Costco only has about, say, 3,700 to 4,000 different products.
That sounds like a lot, but compared to others.
It's tiny. A typical supermarket or supercenter might have 30,000, 50,000, even over 100,000 SKUs.
Whoa. Okay, so focusing on fewer items means they buy massive quantities of each one.
Exactly. It concentrates their buying power like a laser beam, gives them huge leverage with suppliers.
Makes sense. What else contributes to keeping costs down?
Well, they do a lot of direct sourcing, cutting out middlemen. Their logistics are super efficient, getting stuff in and out quickly, minimizing storage.
And the stores themselves, right. They're not exactly fancy.
No frills is the name of the game. Concrete floors, industrial shelves, merchandise stacked right on the pallets it came in on. Everything is designed to save money.
And those savings theoretically go back into lower prices for members.
That's the model. And then you have Kirkland's Signature, their private label.
Ah, yes, Kirkland. It's almost like a cult following for some of those products.
Right. And the analysis points out it's not seen as some cheap generic. It's known for quality, often as good as or better than the big national brands, but cheaper. That builds enormous trust.
Trust is huge in retail. What about things like the gas stations and the food court?
Those ancillary businesses are really smart. Gas, pharmacies, optical, travel.
Yeah.
And yeah, the food court. That
Yeah.
legendary $1.50 hot dog and soda combo.
Hasn't changed price since 1985, right? Amazing.
It's incredible. And these things aren't just little perks. They're major traffic drivers. They get people into the warehouse, reinforce the value idea.
So it all ties together. The membership fees allow low margins, the low prices and trusted brands drive membership and volume. The volume gives them buying power. The operational efficiency keeps costs low.
And they share the savings, which starts the whole cycle over again. It's that self-reinforcing flywheel.
And this model seems like it would be pretty resilient, right? Especially if the economy gets shaky.
Absolutely. The analysis highlights its defensive and counter-cyclical nature. When money gets tight, people focus on value.
And Costco is value, so they might even gain customers during a downturn.
Often they do gain market share. Plus, that stable membership fee revenue acts like a buffer. It makes their profit much less volatile than typical retailers.
Okay, so a really strong, resilient business model makes sense. Now let's talk financials. Given everything we've said, you might expect amazing profit margins, but that's not quite the story, is it?
No, and this is a key point, maybe the aha moment for some folks. Costco intentionally keeps its gross and net profit margins low.
How low are we talking?
Well, gross margins are around, say, 12.7%. Net margins around 2.8%.
And how does that compare?
Competitors like Walmart might have gross margins closer to 24.5%, Target even higher at 27.9%. So yeah, Costco's looks low.
So why isn't that a red flag?
Because, as the analysis stresses, it's a strategic choice. It's how they deliver the value. They're not trying to maximize profit on each item sold.
They're playing a different game.
Exactly. It's a volume game, a velocity game. They make a tiny bit of profit on a massive number of items sold incredibly quickly.
So looking just at margins misses the point. Where should we look instead to see their profitability?
You need to look at how efficiently they use their resources. Things like return on equity, ROE, and return on assets, ROA.
Okay. And how do those look for Costco?
Pretty impressive, actually. Their ROE is nearly 30%. Compare that to Walmart at around 21.7%. Target's is similar to Costco's at 30.1%.
Okay, so very strong ROE. What about ROA?
ROA is over 10%. Again, compare that to Walmart's 6.4%, or Target's 7.9%. So they're generating better returns on their assets, too.
But if the margins are thin, what's driving those high returns? How are they doing it?
The secret sauce, according to the analysis, is asset turnover. It's exceptionally high.
Asset turnover, meaning how quickly they sell through their inventory and use their assets to generate sales.
Exactly. Costco's asset turnover is about 3.65 times. That means for every dollar of assets they have, they generate $3.65 in sales.
And how does that compare?
It blows the other way. Walmart's is around 2.65x. Target's is about 2.05x.
Wow, so they are just incredibly efficient at moving merchandise. That speed makes up for the low margin.
That's the core of it. High velocity, low margin. It's how they generate superior returns despite not having flashy margins. Think of the DuPont analysis. Asset turnover is a key lever driving their ROE.
Okay, that makes a lot more sense. It's not about the profit per item, but the profit per dollar of assets driven by speed.
Precisely. And financially, they're very strong elsewhere, too. Huge cash flow generation, over $12 billion from operations in the last 12 months.
And debt.
Very conservative. Debt-to-equity ratio is only 0.21, so very low financial risk there.
All right, so operationally brilliant, financially super efficient, resilient. It sounds like the perfect company.
It's definitely best in class. Consistent growth to revenue CAGR of 11.2% from fiscal 2020 to 2024. Operating income grew even faster, almost 15% CAGR, showing that operational leverage.
Okay, but here comes the paradox we started with.
Yeah.
If the company is this good,
The market knows it. And that's the problem, or rather the challenge for investors. Costco's stock trades at a really significant and persistent premium.
a premium compared to what?
Compared to its peers, compared to the broader market, even compared to its own historical valuation levels. This is the absolute core conflict in the investment thesis today.
So how big is this premium? Can we put some numbers on it?
Yeah, the analysis looked at this closely. Using a discounted cash flow or DCF model, which tries to estimate intrinsic value based on future cash flows. And using pretty conservative assumptions, mind you, like 7% revenue growth, a 9.5% discount rate or WACC, 3% long-term growth. The estimated intrinsic value came out around $715 per share.
Okay, $715 based on the DCF. What about comparing it to other companies, the relative valuation?
That's where the premium really jumps out. Look at the price to earnings, the PE ratio. Costco's is currently around 53.7x.
53 times earnings. That sounds high for retail.
It is. Compared to Walmart at 29.2x, Target way down at 16.3x, even BJ's Wholesale, another warehouse club, is only at 22.2x.
So more than double Target's PE, significantly higher than Walmart and BJ's. Wow.
It's the same story across other metrics. Price to sales, price to book, EV/EBITDA to Costco trades at much higher multiples than its peers.
So why? Why is the market paying such a huge premium? Is it just hype?
The analysis suggests it's not just hype, it's a premium for quality. The market recognizes Costco's superior metrics, its defensive model, that wide economic moat we talked about.
So a premium is probably justified.
Likely, yes. But the critical question for you, as an investor, isn't if a premium is justified, but whether the size of the current premium is reasonable. Is it too high?
And what does the analysis conclude on that?
It suggests that yes, it probably is too high right now. trading at over 50 times earnings. It seems the market is pricing in, like, absolute operational perfection and continued strong growth for years to come.
Which leaves very little room for error, right?
Mhm.
Very little margin of safety if things don't go perfectly.
Exactly. So putting the DCF and the relative valuations together, the analysis estimates a reasonable fair value range for Costco might be somewhere between, say, $730 and $800 per share.
Okay, so well below where it's often trading recently. This clearly points towards valuation risk.
Definitely. But before we get to the final recommendation, let's quickly touch on that economic moat and future outlook. How durable is Costco's advantage?
Yeah, good point. We mentioned the moat earlier.
The analysis confirms it's wide and durable, built mainly on two things.
Yeah.
That cost advantage from their scale and efficiency.
And intangible assets,
Yes.
like the brand reputation and the loyalty to Kirkland's signature.
Right. And if you look at it through Porter's Five Forces framework,
The competitive forces analysis.
threat of new entrants, low. Huge barriers to entry, supplier power, low. Costco's huge. Buyer power, individually low, but collectively high, keeps them focused on value. Threat of substitutes, high from supermarkets, Amazon, etc. But Costco's model is unique. Rivalry, high, especially the Sam's Club.
So overall, a strong competitive position, but there are still risks for investors, especially given that valuation.
Absolutely. And the number one risk, highlighted clearly in the analysis, is valuation risk.
Meaning the risk that the stock price falls simply because the multiple contracts, even if the business does okay.
Precisely. Because the expectations are so high, baked into that premium multiple, any slip-up may be slightly slower growth, a bit of margin pressure, anything that disappoints the market.
Could cause those multiples to shrink rapidly, and the stock price could take a sharp hit.
It's the most significant, immediate risk. It's not necessarily about the business failing, but about the stock being priced for perfection.
What other risks are worth noting?
Well, there's the idea of membership saturation, especially in mature markets like the US and Canada. Can they keep growing that high-profit membership base at the same rate indefinitely? Maybe not.
That makes sense. Growth has to slow eventually in established markets.
And of course, intense competition isn't going away. Walmart, Target, Amazon, they're all tough competitors adapting all the time.
Okay, so valuation risk, potential saturation, ongoing competition. But what about the upside? What are the opportunities or potential catalysts?
The biggest one, long-term, is international expansion. Costco is still relatively underpenetrated in many large markets, especially in Asia and Europe.
So lots of room to open new warehouses outside North America.
Huge runway there. They plan to open 25-30 new locations a year, and a good chunk of those are targeted internationally. That's probably the most significant long-term growth driver.
What else could give the stock a boost?
An impending membership fee increase. It feels overdue.
They haven't raised it since 2017, right? And they usually do it every 5-6 years or so.
Exactly. History suggests one is coming. And because that fee income is almost pure profit, any hike flows almost directly to the bottom line. It would be a significant boost to earnings.
That's a pretty clear catalyst to watch for. Anything else?
Just their continued investment in e-commerce and digital. They're not ignoring online. They're building out their capabilities to integrate with the warehouses and capture that spending too.
Okay, so international growth, a likely fee hike, and digital efforts are the main opportunities.
Those seem to be the key ones, yes.
All right. Let's bring this all home. We've got this fantastic, best-in-class company.
An operational marvel, truly resilient, great financials, driven by efficiency.
But the market knows it, and the stock trades at a very steep premium, leaving little margin of safety.
That really sums up the dilemma. The quality is undeniable. The price is demanding.
So what's the bottom line? What's the investment recommendation coming out of this deep analysis?
Based on a typical 12-month investment horizon, the recommendation is hail day.
All day. Okay, interesting. Why not sell if the valuation looks stretched?
Because, frankly, selling one of the world's highest quality, most durable businesses is often a mistake in the long run. Its defensive nature offers downside protection, and the long-term growth story, especially internationally, is still very much intact. You generally don't want to part with companies this good unless something fundamentally breaks.
Okay, don't sell quality. But then why not BUY? If it's that good, shouldn't you own it?
Simply put, the current valuation makes the risk-reward unfavorable for starting a new position right now. The price already reflects so much good news.
There's limited upside from the multiple expanding further.
Very limited, and there is significant downside risk if the multiple contracts, even just a little bit. If growth slows slightly or they miss expectations, the margin of safety just isn't there. at these levels.
So what's the actionable advice for you, the listener, based on this Heredia rating?
Well, if you already own Costco shares, the advice is to hold on. Keep benefiting from the company's quality and long-term compounding. Don't get spooked by the valuation into selling a great business.
And if you don't own Costco, but you're interested,
The advice is patience. Put Costco right at the top of your watch list. Wait for a better entry point.
what might that look like?
It could come from a broader market pullback that drags everything down, including Costco, or maybe some temporary company-specific issue arises that worries the market short-term but doesn't actually break the long-term story. That could create an opportunity.
So hold if you own it, wait for a pullback if you don't. It's a nuanced view.
It has to be. Costco is an outstanding company, no doubt, but the stock price demands a hefty premium right now.
Which leads us back to that fundamental question for you, the listener. What does this mean for your investment strategy? Are you someone who's willing to pay almost any price for top quality?
Or is having that margin of safety, that cushion against things not going perfectly, absolutely paramount in how you make investment decisions?
Something to really think about. It gets to the core of investment philosophy.
It really does.
Yeah.
We hope this deep dive gave you some clarity on Costco and maybe on that broader question too.
And if you want more deep dives like this one, helping you get quickly informed on complex topics, make sure you subscribe to The Deep Dive. We'll bring you the fastest updates and analysis.